Hello and welcome to the Providence Investment Update for January 2023. My name is Michael Ogg. I'm a Senior Advisor and Director at Providence, and I'm joined here by Mark Waite, Head of Investment Strategy. Welcome, Mark.
Thanks, Mike.
Now, Mark, before we get into the detail, you've now been at Providence for 3 or 4 months. How's it all going?
It's been an honour to join Providence as the Head of Investment Strategy on a full-time basis. I've been lucky enough to have been on the investment committee for the last 4 years, and I've known from that experience the acute focus that the team has on serving the client's best interests in an independent manner. And very high quality team of individuals and very focused on achieving very good risk-adjusted returns for the clients, along with Providence's mandate to really preserve and protect wealth.
Well, Mark, we've really enjoyed having you, so welcome. I'll get into the title of the Outlook, which is As Reality Bites, Opportunity Arises. Can you just expand on what that means?
We wanted to really encapsulate what happened to public markets in 2022. So significant upside surprises on inflation, significant interest rate increases from central banks around the world, and the fact that bond yields moved from being very negative on a real basis, and most importantly, we moved from an environment where there was 15 trillion of negatively yielding debt to an environment on the 5th of January where there was no negatively yielding debt. And so most importantly, in 2022, if we look at the public markets, the only things that beat cash were commodities and gold. So it was a very, very difficult environment for 2022. And what we wanted to do was say, given that we've had that experience, how is that going to impact the real economy? How is it going to impact earnings for equity companies in 2023? So that's what we're looking at.
So in terms of just the challenges in 2023, can you just expand on what they are?
So I think there's some challenging areas for financial markets, and they're probably most acute in the private asset markets. So we had a perverse environment in 2022 where essentially the worst performing class of the ASX equity market was listed property, with a return of above negative 20%. Against that, unlisted property increased by close to 4 percentage points for the year. So there needs to be a repricing in some of those markets. Similarly, in some of the private equity markets, potential venture capital markets, and that'll have a real flow-on effect to the real economy. The second thing I think we're capturing is, if you think about mortgages in Australia, mortgage rates are moving from around about 2 percentage points to 6 percentage points. Significant drain on household disposable income, and will definitely have some impact on the real economy. So we're really watching how they progress. Like those events are likely to create some volatility in markets during 2023, and we think it'll be that volatility that will present some really interesting opportunities.
And I guess the Fed raising rates by 25 basis points last night also adds to those challenges?
Well, I think what's interesting about the Fed is more the narrative than the action. And so if we go back to October of 2022, bond markets could see the damage that tight monetary policy was doing to the economies. And we really sort of saw a peak in bond yields at around about 4.25%. And since then, it's been trafficked towards 3.5% for bond yields. And I think that what that's saying to us is they felt the Fed was being too aggressive in terms of policy. Indeed, some of the members were talking about interest rates moving up to 6 percentage points. And Jerome Powell's narrative in the press conference last night was one of, we're starting to see disinflation. We're not seeing a wage price spiral. We're happy with where core PCE inflation is on a short-term basis. So I think when we capture those things, it really means that for markets, there's been a passing of the baton from deep-seated concern about inflation and central banks needing to put economies into deep, deep recessions towards one about central bank policy is already tight, that's going to impact the real economy. So what's happening to growth? What's happening to earnings? And we think this is going to be really key for 2023.
So on that, 2023, new year, new opportunity, potentially new ways of positioning the portfolio. Can you just talk to that?
So I think what's interesting is when we talk about bonds, bonds have gone from being a pariah to potentially something that's very useful in portfolios. And indeed, we've actioned on that by increasing our weighting to fixed income in our balanced portfolios. So I think that's very interesting. We also think gold will continue to be a very interesting geopolitical hedge for the portfolios. And indeed, you've seen significant demand for gold during the fourth quarter of 2022 and 2023. We also think that the opportunities will come from sort of lower valuations in public equity markets. We moved some money into Japan, which was a good move, and we continue to think that will do well. We're seeing some value in global small caps. We're seeing some value in sort of listed property. So there's a range of different asset classes that are going to be very interesting this year.
And on that distressed debt and that sort of thing, is that sort of starting to pop up on the radar yet?
That's something we've been spending a significant amount of time reviewing managers in that space on. We think that'll be a very interesting asset class for the next 3 to 5 years. As the burden of debt, where people have borrowed a lot of money at close to zero interest rates, comes up for restructuring, new financing needed, we think the right managers in that space should be able to provide us with equity-like returns with a reasonable protection on the downside. So we're doing a lot of work there and intend to make an allocation in the not too distant future into that space.
So it sounds like 2023 is potentially, a very interesting year from an investment perspective.
I think it's going to be really interesting because it's going to be bumpy, and indeed markets have started the year on a quite positive tone, but we can see a little bit of a sort of a sawtooth pattern. But we think actually capturing some of the downside in terms of increasing exposures to some asset classes during the year is really going to set the portfolios up for the next 3 to 5 years. So we feel very excited about the opportunities in 2023.
Well, Mark, thank you very much for your time. Thank you for your insights.
You're welcome.
And thank you for joining us. I hope you enjoyed the discussion. If you do have any questions, please don't hesitate calling me or anyone at Providence, and we can help you out. Until next time.